Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Game 5 of the 1973 NBA Finals would be the last one played by Wilt Chamberlain, as the Lakers lost to a New York Knicks team that featured basketball legends Walt Clyde Frazier, Earl the Pearl Monroe, and Willis. A fourth Hall of Famer, Dave DeBusschere, donning the number 22, also played an instrumental role in what was the last championship for the Knicks. 50 years later, his son, Dennis DeBusschere, is a co-founder and the Chief Market Strategist at 22V Research, a firm advising institutional clients on risk and asset allocation. My conversation with Dennis explores his process for uncovering the interaction between the economy, inflation, and the Fed's reaction function. He emphasizes the importance of the financial conditions channel, asserting that economic growth that proves too resilient will force the market to ultimately confront policy that is higher for longer. A large part of the conversation is around the linkages that Dennis and his team find in various equity factors to macro variables like the shape of the yield curve. Of these, one interesting assertion is that defensive stocks and factors like low vol have provided little safety in the context of the recent bear steepening. Lastly, we talk about hedging in an environment of stock-bond correlation levels that remain unfriendly. Here, he points to a customized short basket he's developed comprised of stocks with deteriorating short-term debt fundamentals and high cash flow volatility. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Dennis DeBusschere. My guest today on the Alpha Exchange is Dennis DeBusschere. He is the Chief Market Strategist and a co-founder of 22V Research. Dennis, it's great to have you on the podcast today.
Great to be here. Thanks so much for asking me to come on.
Yeah, it's great to reconnect and excited to have the conversation, explore the here and now of markets and specifically your framework for uncovering value as we try to assess some of these dynamics from a cross-asset standpoint. What's happening in the bond market seems to be of great consequence, at least potentially, for equity markets. So I'm excited to have the conversation. Let's kick it off. And why don't you first start with a little bit of the founding of 22V? And that's going to lead, I think, naturally into a conversation about some of your framework for thinking about risk and asset allocation on behalf of your clients.
Sure. And thanks for giving me the opportunity to do so. So 22V, we launched officially January 2021. I was at Evercore ISI. The predecessor to that firm is ISI, Institutional Strategy Investment, founded by Ed Hyman, which people that listen to this will, I'm sure, know of Ed at the very least. That business was sold to Evercore, and then about a year after our obligations were up, because COVID hit, a group of us decided to form 22V Research. The 22 is in reference to my father, played for the Knicks many years ago. So that's where the 22, and V is for victory. One of the unique aspects of what we're doing is when we launched the firm, I was very interested in partnering from a research point of view with some people that have been in my macro network for many years. And just about all of them have buy-side experience. So I wasn't very interested in gathering a bunch of macro folks that have been around the sell side for a long time and just trying to bolt on to start in the research business, but really have people I thought that were unique, had actually been on the buy side, know what it's like to put risk to work. So that was behind some of the hires we had on the economics team, the policy team, China research team, commodities, et cetera.
Well, as you mentioned ISI and talk about Ed Hyman as the founder of that firm, has a incredible reputation as a very, very client-centric individual. And it seems to me that his ethos on delivering to clients has really been something that folks like you and many of the other ISI spinouts have really taken to implement. And so I was hoping maybe we could start, we'll obviously talk a lot about markets, but maybe we can start with the customer side. So you've been at this for a while. We've gone through all these different cycles, the GFC, and then the low rate period that followed, the COVID crack up, and now this inflation kind of regime and the Fed tightening cycle. But amidst it all, we're sitting here covering clients and trying to deliver value to them. How would you say the client base with regard to its demands from folks like you has evolved and changed over time? I was hoping maybe you could start there. Just give us some perspective on your own journey in covering accounts over the many years you've been doing this?
Yeah, I really enjoy that question because it's kind of part of the DNA and building of this firm. If you go back to 2006 as an example, when I was at ISI and preceding the financial crisis, macro was interesting to macro funds, and it wasn't very interesting to long short equity as an example, or long only equity. And it was, I think, in the background, trying to get the big trends right. But the financial crisis forced people to get up to speed on macro very quickly. Obviously, at a long-term, like you mentioned, low rate environment where that kind of subsided a little bit, but people were getting smarter on the macro, mostly because stocks were trading more in baskets and factorized and mostly influenced from a volatility point of view by the broader macro backdrop, like why certain factors are moving, why are they moving relative to Fed, let's say, rhetoric changes, to use an easy example. And so relative to where we were in, say, 2006, 2013, 2018 to today, our clients across the spectrum are much more macro aware and smarter, which requires you to be even more intelligent in your analysis and drawing out the practical implications for them relative to where we were in, say, 2006 through 2008, where at ISI, we were probably the only game in town and doing a lot more basic things just to help people get up to speed. I don't know if you've seen that shift, Dean, but I think that's a very interesting shift that's happened over the last 20-ish years.
What I found personally is, of course, there's categorization of clients, macro and long short equity and market neutral. And I think to some degree, this is really what the consultants need in terms of bucketing different strategies. But I've always found as well that each client is totally unique. Someone might call themselves a long short equity fund and kind of be obsessed with macro. Another long short equity fund might say the macro is a complete distraction to me, and I'm just going to focus on the bottoms up. And then just back to Ed Hyman, just hoping to get a little bit more of your insights on that with regard to the client coverage model, because that's really what we're all in.
For what we do, the client coverage model hasn't changed. So I bow to the altar of Ed Hyman on this one, where I think you have to be part of your client's process. They have to trust you, and sending out a report and hoping they read it is no way to build a business. So from a client coverage point of view, that hasn't changed the way we do it. I think on the broader sell side, there has definitely been an effort to try and measure all things that are going to clients and then come back and charge them for such things, right? So whether that's you figure out that Dean is reading X amount of reports and you go back to him and say you owe us money. And that is something that is, I think, changed across the street that we're pushing back on and kind of, in a sense, going back to an old school model of partnership coverage, helping them work through issues. So I view our research that we put out as like kind of the tip of the spear, and then having deep relationships with trying to help clients figure out where we can be helpful, where we can help them understand things. That hasn't changed for us. I think it's still extremely useful. I think in the broader industry, it clearly has changed.
If you were to assess the types of questions that clients are engaging you and your team on now, the demands for investigation, for helping them figure things out, how would you put that into context for us right now? Where is the time being spent on behalf of clients?
Well, to your point earlier, it's a little bit depending on the client you're talking to, but I would say to focus in on equity investors for a second, there's clearly a lot more conversations around why their stocks are moving. So helping them be aware of funds that are invested and doing long short, as an example, in a certain sector, and trying to understand why their stock, when nothing has happened, has moved significantly because of some type of factor move related to something going on in the macro backdrop. So we spend an enormous amount of time dealing with that type of question and helping clients think through that, which was not the case 10 years ago. Everybody seems to be aware of that now because everybody has a little bit more of a risk management framework relative to 10 years ago. I think that's a requirement from the consultants that you mentioned earlier. Even if you're a single strategy manager, generally you have to have some type of risk management framework and understanding. And so that's why we tend to have a lot more conversations around those type of issues.
So on the portfolio strategy side, why don't we start here just from a little bit 30,000 feet with regard to your framework. So you're not a pure economist, but obviously you've got colleagues who are totally engaged on that side of things. You're bringing in analysis of the Fed, valuation. I definitely want to circle back to some of the work that you're doing on the factor side. I find that super interesting in terms of the attribution. But maybe give us a little bit of your framework with regard to what's important to you, maybe how it's evolved or how it's developed over time. We started the conversation by saying you've seen a lot of movies over the years, different cycles. So just characterize your framework for us, and then we can kind of dive into some of the particulars of what you see now.
The best way to answer that is we take a lot of pride in looking at the economy and the market, take the S&P as an example, on a bottom-up basis. So I think that's a little bit differentiated than maybe some of the more popular economists look at the economy, which is more regression analysis based. We tend to look at things on a bottom-up basis to ask the question, what exactly is going on underneath the surface? And I can come back to some ways in which we do that, as opposed to just saying, when PMIs do this, everything else happens. That very well might be the case, but I like to confirm that on a bottom-up basis. With regard to the S&P, it's similar, where we basically, from a valuation point of view, look at the market and basically a discounted cash flow analysis framework. To be very candid, we've lifted this way of doing it directly from Aswaf Damodaran at NYU Stern School. For people that listen, they probably know him. Dean, if you don't know him, which you probably have heard of him, by the way, he's kind of the Yoda of equity valuation. And I can get into the details of that, but I think his way of looking at the world when thinking about valuation, which is essentially a form of equity risk premium. So what is the implied fair value of the market based on your future expected earnings growth, potential cash return, which is really important and not focused on enough now, relative to your current risk-free rate? And how does that appear relative to history? So that's a starting point. And right now, that's really interesting because you get different conclusions looking at it on an implied equity risk premium, which is the DCF model that we would use, versus just normal equity risk premiums, standard ones that you see, which is something I can get into as to why, but that's a really important difference. And so that's our starting point on the market, thinking undervalued, overvalued, kind of more or less fairly valued. And then we think about economic drivers, what's going on with the economy from a bottom-up basis, which gets you into your expectations for final sales to domestic purchasers, which is your kind of underlying demand in the U.S. economy. And then the last piece of that is monetary policy. And I think where we're different on that is we focus very little on the mechanics of monetary policy and mostly on the intent of the Fed. And I think this is something that investors get wrong, to be candid, a lot, which is focus way too much on the mechanics, where exactly the balance sheet is going to be, for example, matters much less to us than what the Fed wants to happen. Is the Fed going to signal that they want growth to slow? If that is the case, financial conditions are going to tighten and everything's going to follow. Or the opposite, would they be comfortable letting growth accelerate? In which case, you'll have a friendly Fed, and then you have to decide whether or not the market is mispriced relative to that outcome. So that's the basic three ways we focus on it. Behavioral does come into the mix mostly, and this is where the art is relative to science. We kind of pride ourselves as being a little bit of, I won't use the dirty word, but if you remember the Penn and Teller's BS on Showtime, where they went around kind of disproving whatever wise tales are out there. So from a behavioral point of view, to the extent that we pick up on certain narratives that are going on in the market, we spend a lot of time trying to aggregate data to confirm or go against whatever that narrative is. And then from there, you find certain opportunities, not all the time at the overall market level, but very much so internally, potentially taking advantage of factor dispersion, sector dispersion, et cetera.
It's interesting. You mentioned the Fed's intentions and what the Fed is trying to accomplish. And certainly in some of your recent work, there is a thread of good is bad. You're certainly not the only one, but this idea that the economy might be, I don't love the word re-accelerating. That almost sounds too strong, but we probably weren't expecting a real GDP print in the third quarter that we actually got. And obviously a little bit of an uptick in some of the inflation metrics. And so it does call to question whether the hiking cycle is truly over or not. So let's circle back to that. But I really want to dive into a little bit more about the equity risk premium, because we're in such a unique time, right? We've got not just a 5 and change percent short rate, but you can go out further and you're closer to 5%, even out 2 years and beyond. And so you might have this sustainability of higher rates. It's not as if the curve is massively inverted anymore and this is going to come and go really quickly. And so set against this newfound short rate or this yield curve that's just lifted up almost by every maturity. Talk to us a little bit more about the equity risk premium. So how do you think about valuation in light of a short rate that's 5% versus one that was just so low for so long in the past?
So great question. It's a question that comes up a lot. So even on a standard equity risk premium, let's start there. And I should have mentioned this earlier. Most people, I don't think, appreciate this, but valuation is very much regime dependent. So let me explain that. When you look at equity risk premiums, and I'll use the standard equity risk premium just now because people will be more familiar with that, which is just your S&P current earnings yield or an expected 12-month basis relative to 10-year yields. It's come down aggressively, which we all know. It's come down aggressively, especially against the post-GFC era. But if you go back to like 1960, what you'll notice is the equity risk premium was unusually high in the post-GFC era. So the post-GFC era, you're basically above the 75th percentile the entire time, going back to 1960 on the equity risk premium. In the pre-GFC era, there's one regime, which is 2000 through 2008. You're lower than that, but not by much now, which would mean you're kind of fairly/slightly overvalued relative from 2000 to 2008. You're overvalued relative to the post-GFC period, which was defined by downside inflation risk. I'll come back to why that's important. And then relative to 1980 through 2000, the market is cheap. Okay. And then the 70s was another period of very high equity risk premiums. Now, when you look at the two anomalies, the very high equity risk premium periods, one was the stagflation of the 70s, the other was the disinflation of the post-GFC era. So in a disinflationary regime, or when rates are pinned at the zero lower bound, you have this persistent earnings tail risk to the downside. Hence, you have a very high equity risk premium. If you have more two-sided inflation risk, if R star, if you will, the neutral rate is higher, so you have a more sustainably higher risk-free rate than the post-GFC period, which means you have more consistent inflation at target or slightly above target. When I say target, call it 2% or slightly above on core PCE, that by definition means you have more stability in earnings outlooks. Hence, you tend to have lower equity risk premiums, which is exactly what we've had now. So even on the standard measure, I would say we're not as bearish as other people, but the market is not cheap. I would say it's, at best, you're probably going to grow with earnings on a go-forward basis, assuming we avoid a recession. So I would call valuation unexciting relative to a current equity risk premium. And back to your point, Dean, you do have higher rates assumed, certainly relative to post-GFC, but keep in mind, higher rates are associated with higher nominal GDP growth and more sustainable earnings growth. In the pre-GFC era, you ran around 9% on earnings growth. Post-GFC, you're about 6.5. So it kind of offsets it. And that's point number one. Now, when we look at it on a discounted cash flow analysis, the market is more attractive. It's not a buy, by the way, from a valuation point of view. It is more attractive if you assume cash returns stay around current levels. Those cash returns are driven by top quintile tech, some pharma, and some financials. So if cash returns, which is dividends plus buybacks as a percentage of net income, stay at the 90th percentile, which they are now, because these companies are monopolies, then the market is a lot more attractive than people realize, assuming a recession is avoided and you grow earnings around 8 to 10%. It's not wildly attractive, but there's a reason why those stocks are up as much as they are, and a lot of it has to do with their sustainability of cash returns.
When you contemplate the hiking cycle so far, so 500 odd basis points in a hurry, it's a real steep one. There's all this discussion about long and variable lags, the extent to which both corporates and individuals, and I think your colleague Gerard has pointed to in some ways, some of the immunization, perhaps, that might characterize both corporate and individual balance sheets not being as exposed to the hiking cycle. Certainly, the floating rate mortgage is not a thing as it was in 2005 and 2006. So that vulnerability is not what it was. Where do you think the economy is with regard to the 500 basis points so far? Are we just waiting for the absorption? Are the lags really long? Or is this it? And the economy is sort of reflects the degree of the tightening so far?
So this is a question that we have a lot of fun with. And I think we're a little bit differentiated. So long and variable lags is very open-ended, as you know, right? And you can look at the data on yield curve inversions or if you want Fed hiking cycles, and when recession shows up, you get anywhere from 11 to 24 months. You could drive an oil tanker through that one, right? I mean, that's a big difference. But stepping back for a second, most of the research suggests in the modern economy, which is basically in the 90s forward, that broader financial conditions are the mechanism through which monetary policy works. So basically, the Fed signals are going to raise rates. The markets discount that very quickly. As the market discounts that, financial conditions tighten. Obviously, stocks go down, 10-year yields, 2-year yields up, credit spreads widen. And the most interest rate sensitive sectors tend to feel that fairly quickly, usually within the first 8 to 12 months. So yes, we've gone fast on the tightening cycle, but the financial conditions tightening was basically a year ago. And from there, financial conditions eased as it became clear that inflation was going to start to come down. It didn't mean it was all clear, but it kind of explains what happened with the market coming off the lows, because odds increased that a recession wouldn't be avoided. In 3Q and 4Q of last year, the most interest rate sensitive sector, housing, had a face plant. So residential investment as a percentage of GDP collapsed. But the economy never went into a recession and financial conditions eased. So you fast forward to this year, that drag is behind us. Unemployment rate never really went up. Wages are still tracking well above pre-COVID trends. And so that tightening of financial conditions that we saw has already been felt. So I'm not worried about the lags. I'm more worried about the Fed needing to tighten financial conditions more because the economy doesn't slow enough to get inflation down. So you don't think about it in lag terms versus the start of the tightening cycle. I think about we already had the first hit to the economy. That cycled through. Lo and behold, we exited the first half of the year roughly a 2.5% annualized GDP growth rate. We accelerated growth in 3Q. We're running at a well above trend pace. Let me explain that. Most economists think the economy can grow 1.8 to 2% given supply dynamics, so your productivity and labor market constraints. And so if you're running well above 2, all things equal, inflation will be biased higher over time. So where we're differentiated is saying the first tightening of financial conditions was already felt, and that already cycled through. And the issue now, which is basically what's happened since August, is the economy reaccelerated at a time where inflation never really got down to target, where you still have full employment. So the odds are is that inflation doesn't continue to decline. The Fed has to tighten more. Market picked up on this right away, hence 10-year yields going up significantly. And if that were to continue, i.e. growth not slow back towards trend, then we could be in a spot where financial conditions just continue to tighten and we end up in a recession. So I'm much more worried about the future tightening of financial or the current/future tightening of financial conditions that leads to a recession, and much less worried about what we already saw last year.
Let's maybe dive in a little bit further on the kind of Fed's reaction function to the data. And it seems to be properly evolving. They seem to incorporate different variables and emphasize different things at different times. I certainly spent a lot of time looking in 2022, for example, at the incredible pricing of options on the day before CPI, as an example. The CBOE has done us the service of creating the one-day VIX. Maybe that'll be a tradable instrument at some point, but you can go back and look at this, and the one-day VIX was in the 30s, basically pricing the one-day event risk around CPI for just about every month. I guess it probably started more mid-2022, but there were 6 or 7 days before the CPI in 2022 where the bid to options really reflected how much uncertainty was coming out of that. And the movement in the S&P reflected the fact that that bid was correct. Now, that's kind of gone away. The market's kind of moved on a little bit from CPI, and maybe the Fed has to some extent too. I think what you're saying is they're looking more at the real economy now. Maybe you could talk a little bit more about how they're thinking about the cause and effect, the causality of inflation at this point, and their emphasis of the real economy.
So I love the question. Thank you, because it kind of, jumping off from what I just said, obviously inflation has come down. And by the way, that wasn't the most heroic statement to make even a year ago because there were such high levels, but both goods and services inflation has come down fairly significantly, even much more than I think the Fed is willing to recognize. That being said, the level of inflation, so core PCE, or which we just got last week, is still well above 2.5%. And I say 2.5% on core PCE because that's probably the tolerable level for the Fed. They're not going to drive us exactly to 2. So they're probably going to be okay with below 3 to somewhere in the 2.5% range. All right. So yes, we've seen a significant decline in goods and services inflation, but those comps where were very easy for the last 8 months are not on a go-forward basis. And we're going to cycle through the owner's equivalent rent headwind to inflation pretty soon. So the main driver of inflation from here is essentially going to be what we expect for wages to be. And the rule of thumb that people are using is roughly 3.5% on wage growth, given assumed productivity at 1 to 1.5, will get you in the range of 2.5% on core PCE. Okay. So from here, given that goods and services, disinflation, that benefit is behind us, it's really about wages coming down to that 3.5% range. ECI today, by the way, was more in the 4-ish or 4.1, depending on the measure you want to use. So still above that, which makes a lot of sense. If you're at full employment and the economy is growing at an above trend pace, then the odds that wages come down to a level that would be consistent with core PCE in a 2.5% range are reduced significantly. And there's actually some odds that inflation actually starts to increase again. So you're sitting on a core basis somewhere in the 3.7 to 4% range. And there's some risk that you stabilize there and potentially even go back up if the economy is growing well above 2. So their focus now is mostly on the growth outlook and making sure that financial conditions are tight enough to make sure that economic growth is at trend or just below it, which is that 1.8 to 2% range. Probably closer to 1 to 1.5 would be better and make them a lot more comfortable. And that's the critical thing to understand. And Powell said it at the last press conference where he said stronger growth equals higher rates. Bond market has gotten ahead of this. Obviously, 10-year yields have moved up significantly. So there's some reason to believe that the economy from here is going to slow, which should take some pressure off of bond volatility, should take some pressure off of rates, and hopefully stabilize risk assets. But that is what the Fed is gunning for now, is to make sure that economic growth, which now is well above trend, at least according to the hard data. A lot of equity investors would disagree with my statement, saying companies are saying something different, by the way, comes down to a pace where they can be comfortable that wages will come down, which would mean overall inflation would get to a place that they could be comfortable with.
I think you answered this question, but I want to ask it anyway in an open-ended format, which is policy right now restrictive? And if the Fed hiking cycle is done, is there a likelihood that we are going to naturally just return, let's use your 2.5%. I think that's good enough for the Fed. So with the stance of policy right now, is that enough in and of itself with no more turns of tightening? And let's just suppose there's not an additional round of incremental rise in long end yields as well. Is that enough to get the inflation metrics back to where the Fed needs them to be?
So the answer to the question over a long enough time horizon, yes. You touched on this earlier, where over time, if you were to keep rates at these levels and 10-year yields were stayed around these levels, eventually mortgage rates would reset higher. That would be a significant drag on household income. Eventually, the increase in credit costs to companies would be an issue. So over a long enough time horizon, the answer to that question is probably yes. And I'm talking like out a year. Over the next 2 quarters, or even within the next year, uncertain. We don't know. I mean, people thought policy was tight enough in May and June, and then the economy reaccelerated, right? Because you were having the hit from the banking crisis. And we never really saw that show up aggressively in the data. So the risk now is more in the next 3 to 6 months. Is the Fed unwilling to wait? What I mean by that is if growth stays this strong and inflation continues to stay well above target, do they continue to threaten to raise or even raise rates to make sure that inflation comes down, thereby increasing recession risk significantly? And the reason they would do that is because when the level of inflation is this high, if they don't, and financial conditions ease, they do run the risk of inflation expectations becoming unmoored and then having to come back much more aggressively later. So we think financial conditions are tight enough now to slow the economy over the next 2 quarters. So to answer your question directly, that would be restrictive. I would say that it's not as obvious of a bet as people make it out to be.
It really brings us back to a conversation that I think started to emerge probably by mid 2021. People started to complain that the Fed was bordering on late and that the insurance policy that they really need was one in which, as you're suggesting, Dennis, by waiting too long, you run the risk of having to overdo it at some point. And I kind of see that same argument starting to reemerge, that you're sort of caught in this tricky circumstance in which the Fed has to take out some insurance against just not knowing. As you say, maybe financial conditions ease. That could happen for any number of reasons, right? I don't think they expected them to ease the way they did in early 2023. We had a bond market rally. We had a stock market rally. The dollar sold off. It was wonderful for the markets, but not what the Fed was trying to accomplish. Here's where I want to shift the conversation, because a lot of your work is focused on explaining the performance of not just sectors, but really factors in light of macro variables like changes in yield and changes in yield curves. And I find it to be really, really interesting stuff, very informative. And so maybe just setting the stage, where I think down, I want to say it's about 8.5% on the S&P since the July 31st peak. The IWM is down about twice that. So there's this sort of stealth bear market that has gotten hold of a lot of sectors, not just banks, but some of the cyclical sectors have done particularly poorly. So set the stage for us just with regard to what you see out there in some of these proprietary indicators that you've created. What are some of the factor performances tell you about the state of the state in terms of where risk lies right now, and specifically setting that against Fed policy and yields?
Yeah, so this is a fun one, because from August till basically 2 weeks ago, mid-August, when it was clear the economy was accelerating, small caps, as you say, deeply underperformed, but cyclicals outperformed defensives. So the market went down, cyclicals did underperform, but defensives were even worse. So utilities, staples, pharma, REITs. That's not normal when you have an 8.5% move lower in the market. Typically, if people were really worried about a recession, defensives would do very well relative to cyclicals. So cyclicals did come down, as you note, but they did a lot better than defensives. Just as an FYI, on the year, on an equally weighted basis, cyclicals have outperformed defensives by 13%. On a cap-weighted basis, it's 33%, thanks to tech. So if you do that and nothing else, you would assume the S&P was up 20-something%. But as you rightly point out, you could look at small caps. You could look at any name with a high leverage indicator, different ways to measure that. You could look at volatility factors, and they all got smushed, like hit very hard. If you knew just that, you would assume the S&P was down aggressively on the year. So what seemed to be priced in was acknowledgement that the economy was strong, right? But also that there's significant interest rate risk longer term. So that is what seems to be driving these internals. At some point, that would flip to real downside economic risk, meaning not just going back to trend, but like maybe to zero and recession, in which case defenses would outperform. But in the current backdrop, very simply, it's this kind of near term, next 6 to 8 months, non-recessionary, high longer term recessionary based on higher rates kind of backdrop that's driving internals. That lends itself to mega caps. It lends itself to the few outperforming the many. It lends itself to small caps underperforming, high volatility, et cetera, underperforming, like I mentioned. So if you look at this year, as a side note, you had very clear outperformance of low volatility and mega cap to start the year. Then in the May to July period, when soft landing first emerged, and people assumed 2 to 2.5% growth for the rest of this year, and inflation was coming down, you saw small caps outperform, risk-on factors outperform, again, leverage, retail, higher beta names, like I mentioned. And that happened through July. And then once it looked like the economy was then going to be significantly above trend and rates then adjusted higher, what happened just happened. So it's a long-winded way of saying, as long as we have the tails being priced, which is too strong growth or too weak of growth, expect risk-on factors to come under pressure, expect small caps to come under pressure, expect mega caps to outperform. And to the extent that we fall back into a 2%-ish range on growth, and people can have comfort that inflation is going to come down to target without the unemployment rate obviously going up a lot, that's how you end up with small caps and the average stock outperforming. That's how you end up with risk-on factors significantly outperforming. That's how you end up with the higher debt names that have gotten mushed again, maybe bouncing back aggressively. And so your obvious question to that is, well, why is that true if the economy is slowing? Well, if you're going from well above trend growth back to trend, it means that your recession risk on a longer term basis is going to be significantly lower. And so if your recession risk is lower because we have more comfort that inflation's going down and the Fed doesn't have to crush things, then those stocks can start to price the cycle, right? There's no pricing of the cycle right now because economic volatility is too high. Exactly what you mentioned earlier, Dean, like financial conditions could ease again. Boom, the Fed has to do more. We could go into recession. We don't know. Maybe financial conditions are tight enough right now that does cause a recession. There's no pricing of the cycle until we have comfort that the Fed is going to be out of the way and inflation is going to be at a sustainably kind of below 3% core PCE basis. So that's how I would start thinking about it when you think about factors and sectors and their relationship to the economy today.
It is so interesting. And it's such a painful and long experience of trying to get some degree of clarity as to where we're going. And I'll just very much contrast it with, I don't know, you can go back, obviously the GFC, but then you had these very short, protracted bursts of volatility. We might throw the taper tantrum in there. We had the China August 2015 meltdown. You have the VIX complex melting down in 2018. You have these very short vol episodes that typically come to a happy resolution for people who are long the market because the Fed has got the scope to essentially say, well, we'll provide some forward guidance, or tapering isn't tightening. That was a great one at the end of 2013. And this just seems to be a long, arduous cycle. I wanted to read something to you that was in one of your notes. I think this is a really powerful statement. I was hoping you could give us a little bit more on it. You say, when bond yields and stocks are negatively correlated, so this is, I would say, characterizes where we're in now, defensives do not provide relative safety and outperformance. And you said that we've got this recent period where the market's down and defenses are hardly providing any refuge. Talk to us a little bit more about that, your work on how the defensive factor, maybe low vols in there as well. How does that interact with bond yields?
So it goes back to a comment I made on valuation before and thinking about regimes. When you were in a persistently low inflationary regimes, you had a positive correlation between yields in the market. And yields were persistently low or below on a 10-year basis, well, obviously 2-year basis, defensive dividend yields. And they're slow growing earnings sectors. So in the current backdrop, to the extent that we had this negative correlation between bond prices and stocks, to the extent that this lasts because there's more persistent upside risk to inflation. In that scenario, by the way, supply is harder to absorb, which is something people talk about a lot now. Then there's no reason to own a very low comparative dividend yielding defensive stock relative to a 2-year bond, unless you have a lot of confidence that you're going to be going into a recession. So if we don't have the zero lower bound risk, then you should assume that defensive multiples will be more in line with the pre-zero lower bound period, which is exactly what we're seeing. They're not. They are only defensive insofar as you could be highly confident you're going into a recession. Like, we avoided a recession for 10 years in the post-GFC period, and defensive multiples went straight up, basically like 13 times to like 24 times at the extreme. So that's the difference now, and I hope that helps explain it, but that's a big difference from a regime point of view.
If we do ultimately get a circumstance in which the medicine, let's just say, and look, the Fed's in a tough spot. They might have been to some degree responsible for the circumstance that they're in now, but it's pretty tough stuff. It's very uncertain, the way in which interest rates interact with the economy. It's not guaranteed with regard to what they're doing. But if we do ultimately get enough of a slowdown, or perhaps it's something exogenous, a geopolitical event, where the Fed cycle is done and dusted and a new easing cycle is upon us because growth is cracked, maybe inflation break-evens have come down significantly. How do defensives do in that circumstance? If you do get a big stock market sell-off and a big rally in something like the 2-year note, are defensives a place to be in that circumstance?
Only for a short window, unlike the post-GFC period where you want to really own them. When I say short window, I wouldn't take it more than 6 months. Based on our view, you're in a consistently higher inflationary pressure backdrop. You have shortages in housing, you have shortages in structures investment, you have higher debt to GDP ratios, you have the Inflation Reduction Act, you have labor constraints, which I already talked about. So you have a private sector surplus, which is not well understood, I think, by a lot of people. That private sector surplus is really important. Taking all those factors together, the second the Fed starts easing, you should probably assume pretty high multiplier effect on that easing, more like we saw in the 80s and 90s and even the 2000s than relative to the post-GFC period, where it was very good for risk assets when they would ease, but you never really got significant economic momentum. We missed our inflation target for 10 years on a core PCE basis. So defensives will work for a very short period of time because you'll have fear of some tail. But the second the Fed starts easing against that, and the second you start to see the 2-year rate collapse, I would argue you're probably going to see an aggressive steepening of the yield curve and some pricing in of the eventual reacceleration in economic growth based on the factors that I just mentioned.
Got it. Makes sense. So initially on the risk off, that's a bond market rally, maybe defensives do well, but ultimately the market is forward looking and starts to reposition itself for an eventuality where the easing cycle actually is good for growth and risk assets.
Which would be wrong. So what I just told you would be dead wrong if we go back to a post-GFC lack of demand backdrop.
Right. Well, let me ask you this. So you've done some work on factor baskets. You're creating baskets that clients can look to with specific characteristics. And one of them that I found very interesting, I'll call it the anti-higher for longer basket. It's a group of stocks with low interest coverage ratios, one that's particularly vulnerable from maybe it's a cost of capital standpoint. And as I referenced, higher for longer. I look a lot at options, and I'll say that 2022 was just brutal for the hedger. The S&P is down almost 20%. A lot of folks using defensive option strategies didn't lose just 20%. They actually lost more. So you think about how incredible it is that the market fell that much, and put options not only didn't make money, they lost additional money. So finding these offsets is particularly important now. And as one of the threads in our conversation is stock bond correlation is not very kind for the 60-40 portfolio. So work on customized baskets like this, I think, is pretty interesting. Talk to us about this kind of debt basket, this low interest coverage basket, and what it's intended to do.
Yeah, so it's a low interest coverage basket, right? And in addition to it, we screen for companies at high cash flow volatility. So you kind of have a double whammy where if you have the same debt dynamic but you have very stable cash flow. It's different than having volatile cash flow. So presumably, one is obviously theoretically much more risky than the other. That basket, to the extent that we're higher for longer, and to the extent that companies have to refinance at rates anywhere near where they currently are, that basket's going to be the hedge against higher for longer. Let's put it that way, to your point on hedging. It's done incredibly well. So marking to market, just to make a point here, if we go through a period of falling 10-year yields and soft landing again, that basket's going to be one of those areas where it's going to have a 2-month period of like 90th percentile moves. But over time, I would expect, again, in the non-recessionary higher for longer scenario, those are the type of names or thematics you're going to need to be short to protect yourself against in your portfolio, essentially.
And then on the long side, so if you were to step back and share with us the characteristics, maybe their balance sheet characteristics, things in the factor world that you look at that are attractive at this point in the cycle, and then perhaps not necessarily fully priced. What does that look like? What set of characteristics are attractive from a company standpoint right now?
I think the one that's most attractive, and I think there's an opportunity to your point, I wouldn't go as far as to say mispricing, because I would assume too much precision than I'm willing to give, but I would say not appreciated and certainly underperformed a little bit recently, would be the GARP factor. So if you look over history in higher inflationary pressure backdrops, so everything ex the post-GFC period, the GARP factor has done very well. So growth at a reasonable price that incorporates some value, some growth. Obviously, it's not a pure growth play that benefits from anchored interest rates. So that's a little bit different than the post-GFC period. We have a macro regime classification model. It's basically, to simplify, just looking at every data point and some key market data points historically to determine what type of macro environment you're in. Are you in a growth environment, a normal environment, a transitionary environment, meaning very uncertain, or recession? Purely quantitative. It's not to be used to necessarily forecasting. In normal economic backdrops, which we are in now and probably remain there if we avoid a recession, GARP tends to do the best from a factor point of view. So I think GARP right now is very interesting. I mean, related, if we can get through when I say related, this is probably obviously the higher beta play on what I just said. We touched on it earlier. I mean, small cap underperformance has been so extreme. On a rolling 5-year basis, you're in like the 8th percentile. The history of being just below the 20th percentile on a rolling 5-year basis is extraordinarily high relative returns with very high hit rates over a 1, 3, and 5-year basis, the timing of which is obviously uncertain, but you've seen it. And the multiple spread between small caps and, like, say, the NASDAQ is in the 90th percentile historically. So to the extent that we remain in a normal backdrop, like I mentioned before, I think small caps are the place to be. And even in a recession, probably, because you'll probably see more money coming out of the mega caps than you would out of the small caps.
So that's a style factor that seems to align a little bit with GARP, small caps, at least at this point. What about sectors? Does this pick up on any sectors? I mean, maybe banks or...
Yeah, so financials are the ultimate soft landing play. It's tough right now. I would be a little hesitant on the banks, mostly because there's a lot of idio there that we don't have access to. Right. And that gets into deposit flight and a lot of things that are going on right now. The money center banks are in a significantly better place. Our call is growth is going to slow. Our call is that non-recessionary way and inflation is going to come down. That right now should favor early cyclicals, defined as tech, discretionary, and communications. And I would say tech X the mega caps. So I'm thinking more mid and small cap tech names, relative to energy, materials, and industrials. So thinking in terms of cyclicals, we'd be much more inclined right now to those early cyclicals, again, tech, discretionary, communications, relative to deep cyclicals, energy, industrials, and materials. And the deep cyclicals suffer now. Obviously, we know China's slowing. Obviously, we know European growth is very weak. U.S. growth is going to slow. It's just a question of it's going to be the hard way or the easy way. The easy way is what we've been talking about the entire time. Inflation comes down in a benign fashion. The hard way is the Fed over tightens. That has historically favored early cyclicals relative to deeper cyclicals. And then you want to own deeper cyclicals when you have a lot of confidence that inflation is going to be accelerating. and interest rates are going up. So that's how we're thinking about it from a sector point of view.
So let's finish the conversation with a topic that's certainly getting a lot of attention. I try to just look at as many sources of financial information as possible, Bloomberg, Financial Times, Economist, Barron's, and just try to see if there's a thread that's becoming more and more consistent. And I will say that the commentary around something I think's been in plain sight for years, which is the U.S. debt problem, has really accelerated. And it's not to be a sky is falling kind of person, but it's to observe the concerns around the U.S. running a 6.5% deficit in peacetime with a 3.8% unemployment rate feels really unsustainable set against a new interest rate regime. You've got your higher for longer basket. And I think the USA Inc. is exposed to higher for longer. I'd love just to round out the discussion with some of your thoughts on the back end, movements in the back end of the yield curve, and how much of it's supply. How do you attribute some of the moves recently in the back end?
Thanks for asking. I love talking about this. So supply is clearly an issue. And supply is a function of higher deficits, right? It's a function of higher debt to GDP ratios. So when thinking about the back end of the curve, when you have a fiscal impulse, which is associated with higher debt to GDP ratios, and a private sector that's running above trend, you have upward pressure on term premium. You have upward pressure on the inflation risk associated in 10-year yields. That means you have a much more availability of risk-free assets at high rates, all of which contribute to increasing 10-year yields. But to make a long story short, fiscal impulse plus real personal consumption expenditure growth running at 3.5% equals higher rates. You have much higher implied inflation, which 10-year yields will eventually have to offset. So when I think about 10-year yields, when I think about what will get twos down on a go-forward basis in a non-recessionary way, since fiscal austerity or fiscal orthodoxy is not in the cards in the next 2 years, the household or private sector needs to slow. That's the only way to have, in reality, for 10-year yields to not move up at the rate we've seen and probably stabilize around current levels. So just for everybody listening, to keep it in context, if we know we're going to have this deficit issue for at least the next 2 years, and that does provide some impulse to growth, you need to offset that, certainly if the economy is growing above trend, with slower private sector growth. So it's absolutely critical then that consumer spending growth slows on a go-forward basis. And that's really the only avenue. It would be better, like in 1990, if we saw more austerity. So then we don't have to worry about the private sector strength. That's not the case today. So as long as we have an economy, private economy, that's running at a pretty hot pace, which it is now. And when I say a hot pace, Dean, I want to make sure people understand this. Hot pace relative to a fiscal impulse. You made the exact point. You have a 3.8% unemployment rate with a wartime deficit. So yeah, the only thing you can do is slow the private sector to offset that, which is not ideal, but it is what it is.
Round it out with one more thought exercise, Dennis. I love the VIX. So if I told you the VIX was at 35 and it was there for, a little bit, maybe it's at 35 for a month or so, what do you think happened? What do you think went wrong? Or what is it going to be that goes wrong for a risk measure like the VIX to get super elevated again? What is the list of things on your mosaic that you worry about that could go wrong?
It's proven that financial conditions now are not tight, which would then potentially require a 6% plus 10-year yield to really slow the economy quickly. That's my first kind of reaction to that comment. To get a 35 VIX, maybe, I think, given current dynamics, probably associated with economic growth continuing to maintain the pace we saw in 3Q. I don't think that's going to happen, but it's plausible, right? We've seen savings rates stay at very low levels before. What if they decline a little bit more? What if spending continues at a very high level? And by the way, spending is not necessarily going to be on things that are interest rate sensitive. It could just be more travel and leisure, more restaurants, all the places that have labor constraints. So then the Fed would signal maybe more aggressive tightening. Maybe Jamie Dimon's comment of 7% is needed. And given supply dynamics, you get a shot to 6% plus on 10-year yields. And then the rest is history. That's my initial reaction to that, outside of shocks that I'm just not thinking of. So yeah, that's the main one I would be focused on.
Well, we're ending the conversation roughly where we began, which is this notion that good is bad. And it's almost as if you try to teach your kids about markets and they say, hey, the unemployment rate went down and there's a ton of new jobs. And you say, well, that's why the market went down 4%. It's a strange world. It's a strange world. Well, Dennis, I've really enjoyed the conversation. I'm glad you took me up on the offer. It's great to reconnect, and best of luck as you build out the business. I found your work really interesting, and thanks for being a guest today.
Dean, great to reconnect with you. Thank you so much for reaching out, and really appreciate the opportunity to talk.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.